Ever wonder why the rich keep getting richer while others struggle to make ends meet? It's not just luck or hard work, it's a set of principles that set them apart. In today's video, we reveal the secrets of the wealthy, uncovering the powerful habits and strategies they use to build and grow their fortunes. Let's explore how you can apply these principles to transform your financial future. Number 1. Big money comes in increments. There are no get-rich-quick schemes except for Ponzi schemes, but those will get you arrested. No one suddenly wakes up rich. Building wealth is a process based on investing. An investment is something to which you commit your time, money, and attention. It's more than about money. Your education and health are investments too. The rich know this and always invest in themselves by learning new skills. Properly made investments tend to grow exponentially. 2 points are essential. Exponential growth is hard to see at the beginning. Exponential growth accelerates. Huge returns come toward the end. If you went to the university, the skills you learned there translated into your job, which translated into your income and new skills, which translated into a higher income and new skills. This is exponential growth. Can insignificant investments lead to huge returns? Yes, this is the compound effect. Assume you invest $1,000 for 50 years at a 7% annual growth rate, perfectly realistic. Note the slow growth in the first 20 years and how it takes off afterward. You'll have made about $30,000 after 50 years without touching your money. That's 30 times the principal. Not bad. Number 2, having the deferred gratification gene. Knowing that huge returns come later is one thing. Exercising emotional self-control to wait for them is another. This is deferred gratification, the ability to postpone an immediate gain in favor of a greater reward later. It's hard in a consumer society. People tend to buy things they don't need or can't afford. If you want to be rich, you should think long-term. The rich don't think of how much $1 is today. They think of how much it will be worth in the future. In the example above, $1 grew to $30 over 50 years. Even if you were smart enough to buy Bitcoin in 2011, you would have had to wait until it took off in 2017 and 2021 to reap huge returns. It also helps to have your emotions under control during market crashes. Will you panic sell your investments once you see the market dive, or stay calm and buy more assets at bargain prices? Number 3, buying assets and avoiding liabilities. Most of us go to work every day. This is equivalent to exchanging our time for money. A lot of people hate their jobs. Yet, they cannot stop working because they will run out of money. They are caught in a rat race for survival. You won't get rich if survival is your priority. The rich know that time is the most valuable asset. This is why they make money work for them, even when they sleep. The key is to buy assets and avoid liabilities. Assets bring you money, while liabilities take money out of your pockets. Start thinking of investing if you haven't already. There are many things you can invest in: real estate, land, stocks, bonds, cryptocurrencies, etc. Historically, the stock market has beaten all other investments. Why? Because the stock market helps distribute corporations' wealth among the population. The US has the largest middle class in the world due to its well-developed financial markets. In 2024, you can build wealth without leaving your apartment or house. Keep in mind that the stock market is rigged to the upside. Number 4, taking calculated risks. The rich know that every investment involves risk. This brings us to your ability to quantify the risk of buying a specific asset. Risk is not abstract. It refers to the probability that you made a mistake in how much your asset will appreciate within a certain time frame. The uncertainty about the effects on your asset price out of your control. You must be able to express risk in numbers when buying an asset. When trading stocks, I always know the profit potential, how high the stock price can go, and use a stop loss when I'll be taken out of the position if the trade goes against me. This tells me how many dollars I can potentially earn and how many dollars I am risking. A reward-risk ratio of 2 to 1 is the lowest I am comfortable with. I am risking $1 to earn $2. The higher the ratio, the lower the risk. This is why it is unreasonable to buy assets during market bubbles. You increase your risk considerably. Once buyers, like you, stop flooding in, the price will collapse. Always quantify the risk when buying an asset. Number 5, money is a means, not an end. The rich are not obsessed with money. Although money can solve almost all conceivable problems, it will not make you happy. We tend to overestimate how happy we will be once we are rich. This is called impact bias in psychology. It is the tendency to overestimate the length or intensity of future emotional states. Don't expect to suddenly get happy once you are rich. First, getting rich is a process. Your emotional state will evolve along the way. You will gradually get accustomed to having more money. Second, money doesn't buy friendship, affection, and love. You must still be an upstanding person. Freedom is the goal, not money. Money will buy you time to do what you want with your life. What would you do if you had enough funds to stop working for money? How would you spend your time? What would you do to make the world a better place? We tend to perform much better when money is not an issue. Number 6, focus on multiple income streams. The rich rarely rely on a single source of income. They create multiple income streams to ensure financial stability and growth. This can include side businesses, rental properties, dividends from investments, and royalties. By diversifying their income sources, they protect themselves from financial downturns and increase their overall earning potential. Number 7, frugality and smart spending. While the rich can afford luxury, they are often surprisingly frugal, prioritizing smart spending and investing in quality over quantity. Instead of spending money on depreciating assets like flashy cars or trendy gadgets, they focus on purchases that either retain value or appreciate, such as real estate, stocks, or fine art. The wealthy avoid debt for non-essential items, choosing to live within their means and using credit strategically for investments or business growth. They meticulously budget and track expenses to understand their financial flow and identify cost-saving opportunities. By practicing mindful consumption, they ensure that purchases align with their long-term financial goals, avoiding impulse buys and focusing on items that truly add value. Even with substantial wealth, they take advantage of discounts and deals, knowing that small savings can accumulate over time. Many invest in their education and skills, opting for courses and certifications that enhance their earning potential. Embracing minimalism, they reduce clutter by owning fewer, higher quality items, which leads to a more organized and stress-free life. Additionally, philanthropy plays a role in their spending, as they donate to causes they care about, making a positive societal impact while often receiving tax benefits. This holistic approach to frugality and smart spending ensures that their money is used efficiently and effectively, contributing to sustained wealth growth. Ultimately, being rich is not about money. Being rich is seeing opportunities others don't see. It's a state of mind. Taking advantage of these opportunities is hugely rewarding. For example, by investing in stocks, you help public companies and the economy grow and earn money along the way. Acquiring the mindset of the rich takes time, but is possible. If you want to be rich, invest in your financial education. You will see the world from a totally new perspective.